Welcome to this explainer. Today, we're throwing on our professional equity analyst hats to conduct a really rigorous stock valuation. Our subject, KLIC&soffa Industries. You might know them by their ticker, KLIC. We're going to tear down their financials, build up our intrinsic value models, and get to the absolute truth behind its current market price.
Here is the agenda for our analysis. First, the KLIC mystery. Then, we'll run through absolute valuation, the residual income test, relative valuation, and an asset-based valuation. Finally, we'll synthesize it all for our final verdict.
Section 1. The KLIC mystery.
Okay, $91.39. That is KLIC's last closing price. As analysts, this is our benchmark. We need to keep this exact figure firmly in our heads as we build out these intrinsic value models to see if we can actually justify it.
And this brilliantly illustrates the central mystery we are investigating today. The stock is on an absolute tear, up over 100% year-to-date. But wait, when you actually look under the hood at the business, the company is literally bleeding money. They posted a trailing net income of negative $64.63 million. So a soaring stock price colliding with negative earnings? That is a massive red flag that demands we do a deep dive.
Section 2. Absolute valuation models.
To figure out the stock's true intrinsic value, we're going to start with a discounted cash flow, or DCF model. The steps are straightforward. First, you project out the future free cash flows. Second, you apply a discount rate, typically your weighted average cost of capital, to account for the risk. And third, bring all of that back to calculate the present value today.
So let's run the actual numbers. We extract a trailing free cash flow of about $76.05 million. Now, if we apply standard default assumptions, like a 5 to 6% market risk premium and a 2 to 3% terminal growth rate, our calculated DCF fair value comes out to just $16.73 per share. Let that sink in. Compare that $16.73 to our $91.39 stock price. We are looking at an absolutely massive negative 446% margin of safety. The raw cash flow just does not support the price.
Now, what if we switch gears and use the dividend discount model, or DDM? Well, KLIC does pay a regular dividend, but the current yield is a microscopic 0.90%. And sure, it has a 5-year compound annual growth rate of almost 8%, but look at that payout ratio. It's completely maxed out at 100% of net income. Even looking at the free cash flow payout ratio at over 56%, a sub 1% yield growing at 8% annually simply cannot mathematically discount back to a $91 share price. The DDM falls apart completely here.
Section 3. The residual income test.
Because our first absolute models are looking incredibly fragile, we have to test the residual income model. This starts from the book value of equity and subtracts an equity charge. Think of this charge as the absolute minimum baseline return investors require. If a company earns more than this hurdle, it's actually creating wealth. If it earns less, it's destroying it.
Well, just look at these deeply negative metrics. KLIC has that negative $64.63 million net income, and the return on equity is a dismal negative 7.83%. Because the earnings are negative, they don't even come close to covering that equity charge hurdle we just talked about. This tells us KLIC generates deeply negative residual income. Far from adding value, this model severely penalizes the valuation.
Section 4. Relative valuation.
Okay, we've seen the absolute math. Now let's gauge what the broader market thinks by running a relative valuation, comparing KLIC's multiples against sensible, publicly traded semiconductor equipment peers. And wow, they trade at a staggering premium. We're talking a forward PE of over 33, a price-to-sales ratio near 7, and an EV to sales over 6. That is incredibly expensive for any company, let alone one with negative trailing earnings. The relative models suggest severe overvaluation.
Section 5. Asset-based valuation, or NAV.
For our fourth and final valuation framework, we want to find the net asset value per share. Because we lack a fully detailed line-by-line balance sheet in the source documents to adjust every single asset to fair market value, we use a reliable analyst trick to reverse engineer it. We take the market cap of $4.782 billion and divide it by the price-to-book ratio of 5.80. That implies a total book value of roughly $824.48 million. Divide that out, and we arrive at an implied NAV of exactly $15.75 per share.
Section 6. Final synthesis.
It is time to bring all of our models together for a final intrinsic value range and our ultimate verdict.
Across every single rigorous methodology, the results are shockingly aligned. Our DCF outputs $16.73. Our asset-based NAV calculations give us $15.75. The residual income model utterly destroys value due to negative earnings, and the relative multiples are just unjustifiably high. Literally every single absolute and relative model definitively screams that the stock is wildly overvalued at its current $91.39 price.
So what should you take away from this explainer? Well, the fundamental data demands a serious reality check. The math points to an intrinsic value hovering right around $16, yet the stock trades near 91. It leaves us with one incredibly critical question to ponder. Is the broader market pricing in some spectacular, completely unprecedented turnaround that isn't in the data yet? Or is KLIC's stock price just a massive bubble waiting to burst? Thanks for joining me on this deep dive. Keep questioning the numbers.